Welcome back to the Wisdom Lifestyle Money Show. I'm your host, Scott Dillingham. Today I have Dave Penyuk with us from Westpac. Oh, shit.
Wealth partners.
Yeah, well, I'm going to redo that. Sorry. It's a tongue twister.
Yes.
Welcome back to the Wisdom Lifestyle Money Show. I'm your host, Scott Dillingham. Today I have an amazing guest with us, Dave Penyuk from Westpac Wealth Partners. Welcome, Dave.
Thanks for having me, Scott. This is exciting to be here.
Yeah, no worries. I'm really excited to share with our investors what you have to offer them. And I know because this is more of a regulated industry, I know there's some disclaimers you have to say first. So I'll turn it to you to say the disclaimers, and then I want to hear your story.
Thank you. I appreciate that, Scott. Yes, definitely more regulated industries. So let's just go through this quickly. As you mentioned, I'm Dave Penyuk. I am affiliated with Westpac Wealth Partners. They're a wealth management firm in the United States, and they're kind of under the umbrella with Guardian. And Guardian is a larger insurance company. So that's kind of who we work with, just to let all your audience members know that. Obviously, this show is for informational purposes only, and that individual situations may vary. Information should be relied upon only when coordinated with individual professional advice. This does not constitute an offer or solicitation of a product or service, and that this is my opinion and not necessarily that of Westpac Wealth Partners or Guardian, as we mentioned earlier. And finally, and we'll probably bring this up a couple times, just that this is not legal or financial or tax advice, and that you should obviously refer to your own financial planner, accountant, tax, and legal person. That's it.
That's awesome. Yeah, no, thanks for that, Dave. You listen, you got to do what you got to do. So I want to hear your story. We're about to open up and share the product that you offer, which I personally think is incredibly valuable for investors that want to invest in the US. But I'd love to hear your story on how you kind of got to this point, and then we'll dive more into the product.
Yeah, sounds good. I'll keep my history brief, just because there's lots of fun parts to it, and I could go on and on and on. But yeah, in essence, my wife and son and I moved down to the United States. We're Canadian, from the West Coast, although we did live in Toronto for a few years. But we moved down to the States coming up on 9 years ago, 2017. And we moved down. I actually was acting at the time. And my wife wanted, better opportunities for us, and she wanted to start a new business. And so we came down on what's called an E2 investor visa. Came down to the States, and she's built that business up, continues to run it, and it's to help people self-publish their own books, nonfiction books, just as an aside. And so we came down, do that, was doing some acting. That was all going good. And then COVID hit. We went back to Canada for a bit. Then we came back down to the States because we really like it down here. And I found myself kind of, we moved to Las Vegas. So originally we were in LA, then we moved to Las Vegas. And before all of that, my wife and I were doing a lot of real estate investing in Canada. And that's what drew me into meeting you, was through one of your mortgage brokers, Jillian Irving, and she worked with us in terms of real estate investing. So it's kind of this whole cycle of coming back around to now as a financial advisor, which I eventually got into a couple of years ago. Is now I'm working more on the security side and insurance side, not necessarily the real estate investing side, although we still have real estate investments. So yeah, I got into this a couple of years ago, and it's really to help people, primarily entrepreneurs, business owners, and investors, not only protect their assets and protect their wealth, but also plan for retirement. And so I loved Westpac Wealth Partners' kind of view on things. It's a very holistic approach. It's not just selling you a mutual fund. It's not just selling you one product. It's, hey, we're going to learn all about you and how can we help you? And that's how I kind of came around to it. I know it's a long-winded story.
No, that's awesome though. No, thanks for sharing. So no, that's great. And it's true. Like investors and everything, like you mentioned, right? You're still investing in real estate. We often look at the investment, but that's only one portion of the total, portfolio. And that's why I'm excited to have you on, because you're kind of the the other side of that equation, now that you've got into the financial planning, that people overlook or don't consider. So, I mean, with that cliffhanger, I'd love to hear more about your product and how you guys can, help Canadians to, let's call, strengthen their overall financial position. I'm going to
Yeah.
call it that because you do multiple things here.
Yeah, for sure, and thank you, and yeah, when I hadn't learned of, yeah, we don't like to call it a product per se, but a
Okay.
strategy, right? It's really around protecting, your wealth, protecting your investments, and so, with Westpac and with Guardian, the umbrella insurance company that we work with, they have a strategy, a product, however you wanna call it, but it really helps people to, both Canadians and Americans, to protect those assets. And this particular product that is geared towards foreign nationals. I heard your podcast the other day with it was Mike. Was it Mike?
Chris.
Chris.
Was it
Sorry.
Chris? Yeah.
Yeah, who really focuses on working with Canadian investors to find properties in the United States, right? So this strategy is really to focus working with foreign nationals. Canadians are considered foreign nationals, and if you have any sort of financial tie to the United States, be it real estate is usually the number one, a business, you might have a business down, obviously down here, or even just have like a large account, account, checking, savings account, whatever, but it's got to be sizable. If you've got some sort of strong financial tie to the United States, even as a Canadian, you can get basically it's whole life insurance. And I'm not going to go through all the different gambits of it because it's there's a lot to it. But on a high level, it can help to protect you should you die and you own, let's just say, a couple $100,000 property in one of the states. Should you die, there can be estate taxes that you have to pay. And for your listeners, estate tax is basically you pass away. Canada only has up to $60,000 exemption. So if you have, say, $200,000 in a property, you die, potentially that 200,000, you only get 60,000 off of that as an exemption. That's going to take you to 140,000. You might have to pay upwards of 40%, it's going to vary, but upwards of 40% on that 140,000. So it can be a pretty sizable bill. And that's just for a, small, not super expensive property. So what this product or strategy can do is should you die, if you have that coverage, that can help pay for those estate taxes. And then you don't have to sell the property potentially to pay for those estate taxes. Now, again, this isn't legal or tax advice. And Canada and the US do have a US tax treaty. So if you set it up correctly with the right professionals, you might not have to pay those taxes, but there's always a chance. So using the strategy, you can at the very least cover that. So you don't have to panic and turn around and sell the property to pay the IRS. So that's just one component of it.
Okay, can I stop you there for one quick second? I just have a question. So you talked about Canada has 60K. So is that part of the US Canadian tax treaty that you get a 60K credit towards the final estate tax that the US would bill you? Is that essentially what you said?
Yes.
Okay.
So that's not specifically of the US Canada tax treaty. That's just how the US, the IRS, any
Okay.
foreign nationals, right? So
Got it.
other
Okay.
countries don't have the same sort of tax treaty that Canada and the US has. So again, I don't want to get down too far down the path,
Yes.
but at the very least, you're covered up to a whopping 60,000, which is nothing, right? In the States, should you pass away, I think it's up to almost 14 million of a estate tax exemption, right? So that kind of shows you the difference. 14 million, if you have $14 million in assets, you pass away. Again, states differ, but in terms of federally, you can get an exemption of 14 million. In Canada, it's only 60,000. The good part is, like I say, there is a US Canada tax treaty. So usually there are some ways to up that number. And again, there's all these different formulas and things, but the best part is, again, if you had this product, at the very least, you know that you are covered for any sort of large tax, estate tax bill you might have should you pass.
Okay. Yeah, and could we dive into how the solution, right? How the solution can help somebody, maybe by illustrating an example of how they could invest in a whole life policy, and then that offsets whatever potential tax consequences they have.
Yeah, and for sure, and I'll get to that. But I do want to elaborate more on this strategy. So it's not
Okay.
just a life insurance product where you die, you get a death benefit. And that's on its simplest form. So we've got that, and I'll bring it through into an example. There are other amazing facets of this strategy. One of which, and the one that I personally love, is the cash value component. So as you're paying your premium, which is level for however long, like it never changes, it doesn't go up and down, it doesn't fluctuate. So say your premium is a couple $1,000s a year or whatever. I'm just throwing that out there. Say it's a couple $1,000s a year. As you're paying it each year, you're building up cash value. So not only do you have this death benefit, which is guaranteed, the 2,000 per year is guaranteed. It's not going to go up or down. You can add to it to increase your cash value, but it's never going to go up for kind of your base premium, if you will. And then the third part is the cash value, which is the part that I actually love. The cash value builds up over time. So every time you pay this $2,000, there's a component of that goes into cash value. And Guardian, the insurance company, will pay basically a dividend on those funds. Now, they can't guarantee a dividend, but they've been around for 160 years. They've paid a dividend every single year. In fact, it usually goes up. Not always. Again, I can't say that it always does, but it usually goes up or can go up depending on the times. So this cash value, that small portion of the premium, the 2,000 per year, is going to grow and grow and grow. And the very cool part of that cash value that I love for investors particularly is it's growing in US dollars, because you got to pay it in US dollars, your premium. It's growing in US dollars, so you don't have to mess around with foreign exchange rates, which, suck right now as Canadians. It grows and grows and grows. And say your roof goes on your property, $10,000 bill. Well, if your cash value is built up 10, 15, 20,000 over a few years, again, depending on what your premium is and the structure of it, it grows up. You can literally, you don't have to withdraw that money. You can take it out as a loan. Take it out as a loan. You don't have to pay it back. You might want to, but you don't have to. It's set at 4.76% loan, but potentially it could be earning 5, 6, or 7%, even though you've taken the money out. So it's like an arbitrage. You pull the money out, you fix your roof, maybe you pay it back over time, maybe you don't. If you don't pay it back, again, when you die, it's just going to take out that loan, whatever amount you pulled out. Okay. Did that all make sense?
Yeah, yeah, I like it. It's super cool.
Okay. So, and that's again the part that I love the most about this is that it's like the Swiss Army knife of protection and investments, in my opinion, because you can do so many different things with it, and you're also not taxed on it. The death benefit is not taxed; it's tax free, and the cash value is only taxed if you withdraw the funds, not if you take it out as a loan. Only if we withdraw, and it's only if you withdraw above what you've put into it. So if you put 10,000 into your cash value in terms of cost over several years, if you pull out and it's grown to 15,000, only that extra 5,000, only if you withdraw, could
Yeah, so like a capital gain.
it's kind of like a capital gain.
Sort of. Yeah.
Sure. Yeah, same sort of principle. Okay, so an example. Unless you had any questions before I give you an example.
No. That's great. I want to hear an example. Yeah.
Okay, so the client buys a property in, I know you were talking about, Michigan, Ohio, a little bit more in Texas and whatnot. Some of your clients are buying down there. So let's just take Michigan. So Michigan, they buy a $200,000 property as an investment property, or certainly could just be a prime, secondary snowbird residence, if you will. Although why would you do Michigan? You might want to do somewhere warmer as a Canadian. But let's just say Michigan. So they buy the property. It's $200,000. They can get up to, again, there's all these criteria that we'd have to go through in detail, but they could get potentially up to 4 times that value of that U.S. estate. So say 200,000, they could get potentially $800,000 of death benefit. All right. Generally, they're not necessarily going to do that much. You're going to kind of do it based on what your estate taxes might be, right? Or some variation. So let's just say it's $200,000, and say they buy it all cash. They don't do a mortgage. Just for simplicity's sake, they buy it for 200,000. They put, let's say, $200,000 death benefit policy in place. 5 years later, maybe it's gone up to, let's just say, 250,000, and they have that $200,000 death benefit, which can increase over time as well. Actually, it does increase over time as you're making your payments. So you've got the $200,000 death benefit. You've got the now what's valued at $250,000 property, and you're building up your cash value as well. So as they're making their premiums, 5 years later, God forbid, they pass away. Now, again, depending on the U.S. tax treaty with Canada, they might not have any estate taxes, but let's just say they do. It's going to be valued at $250,000 at time of death, and they only have $60,000 exemption. Again, unless they can go through the U.S. Canada tax treaty, so that's 250 less 60,000 is 190,000 of estate taxes. Now they're going to pay a percentage on that, and like I say, it can be upwards of 40%. Right, it's gonna vary on a variety of things. Usually, your income level, your marginal tax rate, that kind of thing. But let's just say they hit the top. That's 40%. 40% of 190,000 is right that they're just going to have to write a check to the IRS, to the government. On top of that, and this is something that is a little bit separate, but it's related, is they're going to have capital gains in Canada as well, right? So if they don't have protection insurance in Canada, that capital gains, they're going to have to pay capital gains on that as well, right? Even though it's in the States, they're still going to have to pay capital gains if they pass away, even if they don't sell the property. It's considered deemed disposition. So again, not only are they going to have this $7 IRS bill in US dollars to pay, but they might have whatever capital gains tax in Canada. It could be $10,000, $20,000, $30,000, $40,000. So the $200,000 of death benefit coverage that they applied for, again, it's going to be growing over time too, but let's just say it's at 200,000. They get a tax-free check for $200,000 fairly quickly, just with proof of death, basically. They get that $200,000 in US dollars. They can pay the $78,000 to the IRS for the estate taxes, and then the rest of it, they can, move over to Canada if they need to pay their capital gains and whatever else. So the benefactors or the heirs could do that. So does that, and then again, there's going to be cash value in there as well. The cash value, they would get that at the same time as well. Yeah, I'm glad to hear you say that, and I agree. Once I learned about the product, the strategy, because we have a similar, product, the whole life strategy, the whole life insurance itself in the States that works just as well for Americans, obviously, right? I'm not actually, I pointed at myself, not that your viewers can see, or your listeners can see that. And I'm not American. I have a green card. I was pointing at myself, but it works with individuals like that too. And this particular, again, the foreign nationals program that we have, it can work with whether it's Canadians. You don't have to have a social security number. You don't have to have an individual tax in it. You just have to have that financial tie in the United States, and you have to basically file taxes on that, basically. So as long as you're doing that, you have that financial tie, then we can start to work with you in that regard. And so,
Yeah.
that's how it works.
No, I would say most of our investor clients have an EIN, right? Because they're setting up some type of entity, so they have the EIN, so it works through that as well.
Yeah, definitely. Yeah. And, and it can work with whether you set up a trust, or some sort of, estate plan that way. We can work with that as well, right? There has to be an individual that it's tied to. Obviously, it can't just be, oh, the trust died, so I guess I get my money. No, it has to be an actual person. It has to be the owner of that policy, in essence, or the insured, if you will. They have to be obviously tied to it. But yeah, that's how it works.
Super cool. No, I love it. And I know we generally keep our shows short, and I know, we could actually talk about this, I think, for a lot longer after what I'm finding out and how cool of a product I think this is. But are there any final thoughts about this program or talking points that you think would be important to share with everybody?
I mean, yeah. Again, we could talk about this for a long time, but I think the biggest thing is, anybody that's investing in the States, I mean, first of all, and we don't have to get into this now, but first of all, why are they investing in the States, right? So, and you can answer that obviously better than me, but why are Canadians deciding to invest in the States? And I know part of it is obviously affordability, cost of housing here is less, but there's got to be more to it than that, right? Um, my wife and I wrote a book years ago called More Than Cash Flow around you get what you pay for, right? So you want to be doing more than just, hey, it's cheap, I'm going to buy it. But what is it that's drawing you to the States? And the reason I ask that is not to challenge anybody, but first of all, think of that. And then if you are taking this step to do it, if you're putting your money into a foreign country and you're going to set things up and you're talking to different professionals and doing everything that way, why would you not protect what you're doing down there with your assets and your finances, right? And that's kind of the best thing I can suggest is you're going to all this effort, make sure that you set it up so that if something were to happen to you, you're going to at least let your heirs, your beneficiaries not have to deal with these awful tax consequences, right? Because they'll get that death benefit. So that's the biggest thing I can suggest is if you're going to go to all this effort, this might be a very wise decision to go that way. And then on top of that, you have that cash value, which is the part I love because it's building up over time in US dollars. And the last thing you want is the Canadian dollar to drop to 65 cents on the dollar. And then your roof goes and it's $10,000 US dollars. Well, that's actually going to be, $14,000, $15,000 Canadian that you got to now send down. Unless you're building up something in the States, which is again why I love it because it's building up in US dollars and you can access it at any time.
Yeah.
Yeah.
Yeah, no, and honestly, I think this is super important, especially the fact that you're taxed on the whole asset value because like I feel like I'm repeating myself now, but it's like I look at investors' performas and whatever cash flow analysis daily. This is like our brokerage. This is our niche. And we work with, and speak to thousands of investors a year. And everybody's like, this is my return. This is my return. But nobody is saying, here's my taxes at the end. Maybe I should optimize that, right? Because your return is going to be so much smaller if you don't have that protection. So I actually think it's fantastic to get into, and logically the way I'm thinking, and let me know. But on my end, I would be looking at my expected life expectancy, and I'd be analyzing how long I plan to hold the properties. I'd be looking at the appreciation because you said we could go up to 4 times the value. So I would be factoring in all those things. And let's say this $200,000 home, I think would be worth 500,000. That's the policy that I would be taking out on this. Is that how you kind of analyze it for your clients, or do you guys have a different way?
I mean, it's obviously a lot more involved than that, right? So yes,
Okay.
you're gonna certainly look at life expectancy. You're gonna look at, yeah, are you just doing a flip, right? If you're just buying in the States a flip, you're probably not gonna want to put a whole, policy in place. But if you plan on doing a bunch of flips, then that would be the perfect thing to do because you've always got that bucket sitting there just in case something happened, right? So yeah, life expectancy, how long you plan on doing it, even potentially the value of it, right? It would be another thing that I would look at it. If you're only buying like really, really inexpensive properties and maybe only one, and you don't have plans to do a bunch, maybe you don't want to set all this up, right? It might be a little bit too much for you. So yeah, we really would have to look at the whole picture of that person, both their kind of their goals, short term, long term, and then even just kind of the flux of how much money they're putting into, right? So um if this is all of their assets is just $100,000 property in the States and they're just renting in Canada and they don't really have any other assets, it's probably not going to make sense to do something like this. But if they have some assets in Canada and they're buying it 1, 2, 3 properties down the road, yeah, you're going to want to set this up because yeah, the last thing you want is having 5 properties or something like that in the States. And the tax situation can get quite complex. So if you have this policy sitting there, at the very least, your heirs are going to be covered. They're going through grieving, they're sad. The last thing they want is, man, what property are we going to have to sell to pay this estate tax and to pay that and to pay this? Oh no, we get this tax-free death benefit when poor George passed away. And at least we get that. That can go to anything that we need. and we're covered. We don't have to stress about those things. I think that's a big thing. Is it alleviates a lot of the stress because your taxes at least are going to be covered at the very least.
Yep. Yep. I love it. I love it. No, that's awesome. So we do have to run, but is there any, like, how should people reach out to you if they're interested? Do you have a website, or do you prefer email, phone number? Like, how do people get in touch with you?
Yeah, I mean, I can certainly. My email is it's long, so that's why I don't necessarily want to.
I'll put it in the show notes.
Yeah, do that. Yeah, so you've got my email, the Westpac Wealth Partners email, and then another thing you can certainly do is go to our website, which is Westpac Wealth. It's WESTPAC WEALTH. So westpacwealth.com. And then you can look up who we are and our locations. I personally am in the Las Vegas office. So that's going to be another way you can find us. And you can certainly go onto LinkedIn as well. If you go onto LinkedIn, look up my name, Dave Penyuk, Peniuk. You'll find me in there, and that's another way you can reach me. Or, of course, if you don't mind, reach out to Scott, and you can forward it on to me. That's fine too.
Absolutely. Awesome. Well, thanks so much. I'm glad that you were able to participate in this and we could share this with the world, because I do think it's important. And one other thing that I'll say, because I know we spoke about foreign nationals for Canadians, like as Canadians, but this applies to anybody. So you could be anywhere, correct? Like on your end, you guys, it could be any nationality, correct?
I don't know, not any nationality. We've got
Okay.
kind of a list of A countries, B countries.
Okay.
There's a lot. Let's say that there's a lot of different
Okay.
countries for sure. But yes,
Okay. So more than just Canada.
yes.
Speak to Dave for the full disclosures.
Yeah, and there's a lot of countries that we can work with for sure. I just I don't want to list them all off because I don't know how many. There's quite a few.
But you're right. They're sanctioned countries that, even from a lending standpoint, we can't lend to. So I'm sure there's some overlap there on your end too.
Yeah, for sure. But yeah, if you're not Canadian, you're Australian or New Zealand or yeah, I don't know. There's a bunch, a lot of European countries, all of that for sure.
Awesome. Well, thanks so much for being on today. Really appreciate it.
Yeah, thanks for having me, Scott. I really appreciate being here.
No problem. Thanks, Dave. Take care.
You too.
Dave Penyuk is a financial representative of the Guardian Life Insurance Company of America, New York, New York. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC. This material is intended for general use. By providing this content, the Guardian Life Insurance Company of America, Park Avenue Securities, LLC, affiliates and/or subsidiaries, and your financial representative are not undertaking to provide advice or make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. The primary feature of whole life insurance is the death benefit. All whole life insurance policy guarantees are subject to the timely payment of all required premiums and the claims paying ability of the issuing insurance company. Policy loans and withdrawals affect the guarantees by reducing the policy's death benefit and cash values. 880-7956, 1 EXP 328.